Because Iran demanded toll rights over the Strait of Hormuz, not just a ceasefire, every barrel of oil passing through that choke point now carries a political price tag. The Islamic Revolutionary Guard Corps, which consolidated power after Supreme Leader Khamenei's death, rejected the U.S. 15-point peace proposal and countered with sweeping demands: full withdrawal of American military bases from the Gulf, reparations for war damage, complete sanctions removal, and, most structurally significant, the right to charge ships transit fees, modeled on Egypt's Suez Canal toll. Iran has already begun collecting roughly $2 million per crossing, with reports suggesting payment in yuan rather than dollars. That yuan demand is not incidental. It directly targets the petrodollar system that underwrites U.S. reserve currency status. Only 2 vessels crossed the strait on March 24, versus the normal 150 to 160. The gap between peace talk optimism in futures markets and the physical reality of that near-empty waterway is the central tension in global markets right now. That gap is feeding directly into recession probability models. Moody's Analytics raised its 12-month U.S. recession odds to 48.6%, up from a baseline of 15 to 20% before the war. Goldman Sachs sits at 30%, EY Parthenon at 40%. The mechanism is oil's transmission into consumer prices. Brent crude has hovered near $100 per barrel, reached $115 at peak, and Moody's chief economist Mark Zandi has calculated that oil averaging $125 per barrel through Q2 would be sufficient to tip the U.S. into recession by mid-year. A $1 per gallon increase at the pump is already registering in polls, with Trump's economic approval hitting a record low of 29% in Reuters Ipsos data, below even Biden's floor of 32%. What makes this structurally sticky is the Hormuz supply chain reaching beyond energy. The strait controls roughly 1/3 of global fertilizer flows, which feeds directly into food prices with a 2 to 3 quarter lag. Even a ceasefire this week would not immediately reverse fertilizer and food price trajectories. The recession risk, in other words, is partially baked in regardless of how quickly the shooting stops. Alongside the macro deterioration, Washington made a structural bet on AI dominance with the announcement of the President's Council of Advisors on Science and Technology. Trump appointed NVIDIA CEO Jensen Huang, Meta CEO Mark Zuckerberg, Oracle's Larry Ellison, AMD CEO Lisa Su, Andreessen Horowitz co-founder Mark Andreessen, and Google co-founder Sergey Brin, with David Sachs and Michael Kratsius as co-chairs. Notably absent, Sam Altman of OpenAI and Elon Musk, whose Doge role appears to have cost him a seat at the AI policy table. The council's formation landed on the same day a Los Angeles jury found Meta and YouTube liable for addictive design features that harmed a minor, awarding $3 million in compensatory damages, with punitive damages still to come, after the jury found both companies acted with malice. That creates a direct tension. The same platforms being invited to shape national AI policy are simultaneously being held legally responsible for design choices that prioritized engagement over user safety. Meta stock has traded sideways for a year, in part reflecting this dual exposure. The company's separate announcement of a $9 trillion market cap target by 2031, backed by executive option packages paying out only if the stock rises 500%, suggests management is betting aggressively that the policy tailwind outweighs the liability headwind.
Meanwhile, a different mechanism cracked the memory chip sector this week. Google published research on TurboQuant, a quantization technique that compresses AI model KV cache memory requirements by 6 to 8 times on NVIDIA H100 GPUs, achieving comparable accuracy at just 3 bits. The market implication is direct. If the dominant AI training and inference workloads need dramatically less high bandwidth memory per compute unit, the long-run demand trajectory for memory chips, Micron, SanDisk, is lower than previously modeled. This is not an immediate demand shock, but a structural repricing of the addressable market. The irony is sharp. The same AI infrastructure build-out that has driven memory stocks to elevated valuations is now producing efficiency innovations that threaten to shrink the memory content per server. Investors who bought the AI needs more of everything thesis are now being asked to disaggregate more compute, potentially less memory per compute unit. If Google's technique is adopted broadly, the divergence between GPU-centric names like NVIDIA and memory-centric names like Micron could widen significantly. 3 conditions will determine how these chains resolve. First, if Brent crude holds above $100 with no credible ceasefire by mid-April, Moody's recession probability will likely cross 50%, and the Fed will face a genuine stagflation scenario where cutting rates accelerates inflation and holding rates deepens the slowdown, both outcomes negative for equities. If Iran accepts a partial deal that reopens the strait, even without resolving the toll rights question, oil prices could fall sharply and the recession probability compresses back toward 30%. Second, the Meta YouTube liability verdict moves into the punitive damages phase. If punitive damages run to hundreds of millions, it establishes a financial template for the thousands of similar pending lawsuits, a structural legal cost that no executive compensation package can offset. Third, if Google's TurboQuant technique spreads to other foundation model labs, watch for a sustained compression in memory chip price to earnings multiples, even as the broader semiconductor sector recovers. The AI trade in 2026 is splitting into winners and losers within the stack itself, not just between tech and everything else.